Hey everybody, it's Patrick Moore here with Ironclad Wealth Management. I've got a real quick video for you today on a very specific question. And that's if I took a loan out to buy a business, is the interest on that loan tax deductible? So that's what we're going to talk about real quick today. Now, the big thing that I do want to say is that this is no replacement for qualified professional advice. So you're in the ranks of the business owner world, right? If you've just bought a business, you definitely need to get some professional advice to help you with your taxes these days. So really what this is all about, right, is with your loan that you took out to buy a business, you've got a lot of financial stress and you need to make sure that your financial projections are accurate before you buy that loan. So hopefully you're watching this while you're modeling out your business purchase. But if you're not, don't worry, it's not too late because the good news is that generally these loans are deductible. Now, why does it matter? At the end of the day, nobody wants to work for free, right? And unless you're accounting for your loan properly, there's a chance the interest may not be deductible. Now, if you do, you can see the difference here, right? Essentially, by accounting for it properly, you get a tax deduction, and this is a very basic example. But you can see that if your taxes are at a 37% rate, 37% of that interest payment is something that you could keep in your pocket, which is in this example about a $9,000 difference. Mileage is going to vary. It depends on your personal situation, but that's why this is so important. The more that you account for these things properly, the more money you will keep in your pocket. Now, with that being said, like I said a minute ago, generally, emphasis on the generally, your loan should be tax deductible, but there's a few key tests to review. Now, the first is what's called the allocation of funds, which is also called interest tracing. Okay? Basically, if the loan is actually used to buy the business or for other business expenses, it's deductible because it is a business expense. But if the IRS looks at your books and says, hey, actually, most of this loan was for a car you bought just to go, go out on the town and kind of look good, they're going to look at that. They're going to call that loan non-deductible. That it was for a personal expense. So you can see an example of how that works. If it's 80-20, 80% of the loan interest will be deductible, 20% won't. And then there's the IRS regulation there, the Internal Revenue Code section that governs that. The second test is going to be on the passive activity rules. So your business activity and the loan associated with it will also be subject to the passive activity rules. If it is a passive activity, your loan interest can still offset the passive activity. But if you're running a negative, right, let's say in the first 2-3 years of the business, you're at a loss, those losses, if it's passive, will not be able to offset your active income and basically save you the full extent of those taxes. Now, if it is active, you don't have to worry about any of this. That's the best place to be. So if you are a passive or active investor in the business, really that just comes down to, are you working in the business? And there's a lot more involved in that as far as tests go. I'm excluding real estate in this. That is something you need to keep in mind. Now, the final thing is kind of how to look at this, how to report this. So if you look at this, this is interesting. This is an IRS revenue ruling from, I think, 1987 or 1989. Most people will look at the interest and they'll say, okay, I made $100,000. I'm going to take $25,000 off my interest. That means I made $75,000. And they just kind of put it in their profit and loss statement because it's a business loan. Interestingly enough, what the IRS says is you don't want to have it all kind of mashed together in one line item. If this is a Schedule E, but if it's a Schedule E, you want to have two separate line items. So you want to have one for the business income and then one for the interest, and it still nets out to the same $75,000. But what happens is it's going to have different reporting as far as a few of the other knock-on effects of the business. So it's something where you just want to make sure you have it correct because it's going to pay dividends down the road to have it correct, and it means you won't run into any problems with the IRS. Now, that's a Schedule E. There'll be some different treatments for C Corps, and Schedule C, it'll be on a different section of the return, but it's going to be the same general process where it's two separate items, not one. So if you have to take anything away from this video, I hope the one thing you take away is this, or let's say two. Yes, the loan interest generally deductible. B, you shouldn't be watching a video to figure that out. If you are buying a business, if you're thinking about it, yeah, watch the video, right? But if you have a business and you're going to do this, talk to a professional, talk to a CPA. I'm not tooting my own horn, right? I don't actually file tax returns. I do work with CPAs, but you're at the point in your life where this is going to be important enough that you need to make sure that you have accurate, competent tax advice. So I hope that this made sense. I hope that it helped. And if you have any questions, feel free to reach out and have a good day. Bye bye.